The Retirement Café Podcast, episode 12, Making Your Pension Savings Last a Lifetime with Abraham Okusanya.
Retired or thinking about retirement? You've come to the right place. Welcome to the Retirement Café Podcast. In each episode, we bring you an important conversation with insight, tips and knowledge, all designed to help you live a fulfilling and successful life in retirement. Here's your host, Chartered Financial Planner and accredited later life advisor, Justin King.
Hello and welcome to the latest episode of the Retirement Café Podcast. Now, you'll have to excuse me, you can probably hear I've got a head cold, so I'm very nasally, so apologies for the audio quality of this recording. But anyway, let's crack on. Hello and welcome to the latest episode of the Retirement Café Podcast. This week I'm chatting about pensions and much more specifically about how to manage and make withdrawals from your various pensions or retirement savings to ensure that they provide an income throughout your retirement. Since George Osbourne pronounced the words, "No one will have to buy an annuity again" in 2014, the retirement market, or the pensions market, has changed dramatically. So you're no longer forced to convert your savings into an annuity, i.e. the pension savings. An annuity is a guaranteed income for life, exchange from your pension pot. So pension freedoms legislation allow you much more freedom on how you can spend or how you can use that pension pot, your retirement savings. So fundamentally, this means more people are deciding to invest their pension savings and take an income from these investments to meet their expenditures. But what is the best way to access these hard-earned pension benefits and to be sure that they do last a lifetime? One of the main reasons people seek, the services of someone like me, the financial planner, as they approach retirement is to kind of get a handle on what all this means. So a good financial planner will build you a financial plan, which is in essence a lifetime cash flow forecast. This cash flow will include details of all your pensions, your savings and other assets, as well as any liabilities that you may have. It'll project what you think your anticipated income and expenditure will be for your lifetime based on a number of assumptions around inflation, interest rates, investment returns, and importantly, of course, the crucial thing is how long you will live. You can create scenario plans to include the need for paying for care in later life, or possibly, if you can afford it, give money on to your children or grandchildren. A comprehensive financial plan will go quite some way to illustrating the best or most tax-efficient way to take an income from your retirement savings. What it cannot do so well is delve deeply into a number of metrics like the asset allocation, that's like where the investments are held, whether it's in equities, whether it's in bonds, what the fees are, and the time periods to compare a number of scenarios. So I've been somewhat frustrated at the lack of software available to solve this problem for clients when I was contacted by a friend and peer of mine, Abraham Okusanya. Abraham is my guest on the Retirement Café podcast this week. Now, he's an intelligent chap and very enthusiastic chap who recognised how difficult it was for financial planners to help clients solve just this problem. The problem of working out the best way to take an income from their investments. So Abraham runs a research and consultancy firm called Analytic that provides investment and technical support to financial planners working with retirees. He's also the founder of the Timeline software. It's this software that enables people like me, financial planners, help me work with your clients to work out how to ensure your pension savings last a lifetime. Now, it isn't a crystal ball, but it gives us a real historic evidence of actually what investment returns have been like over many, many different periods. So I'd like to play you my brief interview with Abraham. Then I'll take a couple of moments to explain how this software has been helpful for a number of our clients.
Well, yet again, I'm very excited to be joined by an old friend of mine, Abraham Okusanya, from Analytic, I think it said. He is, he's a specialist in providing technical solutions for financial advisors who help people in retirement. Hi, Abraham, how are you doing?
Hi, Justin. I'm very well. Thank you. Thanks for having me.
Great to see you again, Abraham. Abraham, the Retirement Café podcast is all about providing information to retirees across the UK who are, facing financial decisions, facing decisions in retirement, really,
yes,
in all shapes of different things. Now, I know that you specialise in helping advisors help their clients. Tell me a little bit about your background and how you got into that space and what you do.
Yeah, sure. So first of all, great work, with what you're doing with the podcast. I really like it. I think that, to be in a position to be able to help people beyond just, your clients and the people that you work with on a one-to-one basis, but to reach a wider audience using, frankly, great technology, I think is brilliant. So, kudos to you. Now, yes, in terms of me and what we do, so essentially I run a consultancy firm called Finalytic. We're essentially a research and consultancy firm. So, we see ourselves as the, technical support for financial planners and the work we do around just helping them with the investment proposition and and all the technical research around retirement. I also am the founder of a software called Timeline, which is a software used by just over 300 financial planning firms globally, not just in the UK, to help their client work out how to ensure that their pot of money lasts a lifetime. So yeah, that's what we do.
Yeah. Now this thing about the pot of money to last a lifetime.
Yes.
And this is a huge concern for
Absolutely.
retirees.
Yes.
They've saved hard all their lives. They've got a pot of cash. In the old days, of course, it was a simple calculation. We bought an annuity. An annuity, for those who aren't familiar with it, is this kind of lump sum to an insurance company. They guarantee to pay you an income for the rest of your life. You can have an inflation-linked one or a level one, but really, it just kept on paying out. There's a big shift away from that, isn't there? People they've lost their popularity.
Yes.
And people are moving to kind of investing their pension pot and hoping it will grow over their retirement and provide an income. So, tell me about the challenges around that. So, why is it that people have shifted from annuities to the drawdown pot, I suppose we could call it? The income withdrawal. Why has that happened? And then, that just sounds like really confusing for people.
Yes. I think this is part of a trend that is happening globally. So, if you are a retiree or you're approaching retirement and you're looking at this pot of money and thinking, what am I going to do with this? How am I going to make sure this money lasts a lifetime? You're not alone, because there are millions of people going through this. And the key thing that's driving this move away from, annuities to using your investment port and drawing on that. The key reason is that as a result of the global financial crisis of 2008, hopefully not 2018, the government had to, through the central bank, put a lot of money in the economy, in the system. And the implication of that, let's just summarize that. The implication of that is that drove bond yields down. Yeah. And annuities, which were used to provide retirement income, are based on bond yield, because essentially what happens is that you hand over, let's say, your £100,000 pot, you hand over that to the insurance company. The insurance company guarantees you an income for the rest of your life, however long that lasts, in form of an annuity, and then they take that money, they invest it in government bonds. The trouble is that the return that they get, or the yield that they get on that government bond, is being driven down as a result of this quantitative easing, which is the government the central banks printing a lot of money. And so what happened then was that a lot of retirees in the past, you remember before 2014, most people had to buy an annuity. The rule were designed to happen that way. And then George Osbourne came along, stood in front of a parliament and said these few words: no one would have to buy an annuity. Yeah. The next day, the top search on Google is, what's an annuity? Because people were wondering. So now they don't have to buy an annuity because George Osbourne said so. But the law was changed to ensure that people had more freedoms in terms of what they did with their money. But the implication of that is that essentially we are increasingly moving from a world where, the conversation was all about guaranteeing income in retirement. It was expensive. Let's not, it was expensive to get that guarantee, but we're now in this world where, people can figure out what they have to do, but that comes with risk. That freedom comes with risk and responsibility. And the way I put it is that essentially that change meant that George Osbourne essentially changed our retirement system from one that is by default a safety-first environment to where we are right now, which is best described as an environment designed to ensure that people screw themselves over. So then when you get into this world of using investments to provide retirement income, you have all sorts of issues that you have to deal with, not the least unknown, unpredictable, uncertain investment return, the sequence of that investment return, in other words, the order that you get that return, you have the thief that keeps on stealing, inflation as a risk that you have to deal with. And of course, all of this will be easier if you know how long you're going to live for. If anyone knows, then I'll be quite happy to have a conversation with them. So we get into a lot more uncertainty. And it means that, financial advisors and financial planners, have to be a lot more, thoughtful and, make sure that the way we're helping and guiding people around this is robust and we need to use a lot of data, a lot of evidence to make decisions around this. I mean, you do this all day long, so
sure,
yeah.
Sure, but of course, the big problem is, I mean, your bit of software is highly insightful of past data.
Thank you. You're too kind.
The problem is it's past data, isn't
Absolutely.
it? And it's great data, but it is the past.
Absolutely.
And sadly, you haven't got, maybe in version 3, you'll have the future for us. But at the moment, I know you're rolling out the version 2 soon, but at the moment we don't know what that future is. So, is it any use on the basis that we're just looking at historical returns? I mean, or is it, should we just maybe read our star sign?
Absolutely. I mean, I think, I've said this all the time. So our software uses 120 years worth of capital market data to help advisors make this, make these decisions. But also, we are feeding in data of investment market as things go along, right? And the idea behind that, and I've said this all the time, that if anyone has future data, if anyone knows what investment returns are going to be, in the next 5-10 years, I'll be quite happy to pay them a lot of money for them to give us that data and obviously guarantee it. No one can do that. We don't know the future. All we can do is to look at a wide range of market conditions, from the best of times to the worst. We can look at very, very bad scenarios such as World War I, World War II, Great Depression of 1929, aggressive inflation of 1970s. We can look at the recent financial crisis. And what we want to do is to say, well, we don't know the future. The future is unknown and unknowable. If we build a plan and we stress test the plan, we look at the impact of several different bad scenarios that we've known in the last 100 years. If our plan looks like it's going to be okay in those market conditions, then we can proceed with confidence. Yes, we would need to make some adjustments along the way because the capital markets is going to throw up new things or new situations and scenarios, but we can at least start with a degree and proceed with a degree of confidence. We can also work out what sort of changes we might need to make along the way just to make sure that, we stay on track. So we might say, in scenarios where the capital market declines, then what kind of adjustments do we have to make to our income, to our lifetime? Or do we have to save more, spend less, or die sooner? Is that an option? The idea is stress testing and proceeding with confidence and making adjustments along the way. That's really the best we can do.
Sure. So I think the message here that I'm really hearing is, if you're getting advice, well, first of all, get advice.
Yes, absolutely.
make sure that they're providing, any advisor you're using is using some kind of cash flow modeling software to predict, to show what the future would look like. And then in conjunction with that, to make sure that they're also using the timeline application that can show what would happen with a stress test to your portfolio over different periods of time.
Absolutely.
So we can inform and educate the public about what retirement really looks like for their cash flow model and for their investment returns.
Absolutely. I think if any retiree, I mean, I wouldn't want to, face retirement without those 3 points, working with a great advisor who understands the importance of cash flow planning and who goes an extra mile to stress test and give me some confidence on how to proceed.
No, brilliant. Well, it's been fantastic you joining me today at the Retirement Café, Abraham. It's been, once again, really informative, and I know you're very passionate about this work and the value that you deliver to other advisors. We've worked together for some time now, and it's brilliant to see you again.
It's a pleasure to have you, Justin. Thank you for the incredible work that you do. Thank you.
Thank you.
Cheers.
I always enjoy my conversations with Abraham, and he's just so passionate about what he does. So thank you to Abraham Okusanya for sharing that passion and knowledge today. I use that software in combination with the straight line growth rates that my financial planning software that I use. So that financial planning software looks at the inflation rates, looks at the longevity of how long a client's going to live, and also, more importantly, the tax rates to make sure a financial plan is the most tax efficient strategy that we can provide in retirement. Tax is hugely important. But then we've got to marry those investment returns. People ask me, what is the expected return? Well, this is just such a vast topic about what we think investment returns can be. I can show you 10 periods of very, very poor returns. I can show you 10-year periods of fantastic returns. And this is what we need to do. We need to educate our clients into what is likely, and then make sure that we're actually, if the markets don't provide the straight line returns or the returns that we hope, that we can manage the cash flow, the actually amount of cash that we're holding back at any moment in time to match the client's liabilities or income needs in retirement. So it's a marrying of those two things, and then the continual ongoing analysis of it to really help customers or help clients really understand what the returns, how do we make sure that a globally well-diversified portfolio of well-run companies throughout the world, what's the returns, and what are they likely, or what have they historically been in the past? And then we put the impact of fees in that and the impact of inflation to give us a bit of a steer of exactly what we can expect going forward, or based on historic evidence. It's all based on historic evidence. So, of course, we've got no guarantee that this is going to happen in the future. But at least, as someone very wise said once upon a time, history doesn't repeat itself, but it does rhyme. And in fact, I think that was Mark Twain. But if you want to correct me on that, please send me a comment. So I hope that's been really fantastic. It's really good to chat to Abraham, and it's a tool that I think if you are engaging with a financial planner, ask to see what the historic long-term returns have been of a portfolio that they are recommending or suggesting, so that you can see the impact of that portfolio in your financial plan. In next week's episode of the podcast, the tables will be turned and I become the guest. I was delighted to be contacted a few weeks ago by Carl Richards, who invited me to appear on his new Talking About Money workshop that launches in early February. Now, Carl is the creator of the Sketch Guy column, which has appeared weekly in the New York Times since 2010. He makes complex financial concepts easy to understand through his very clever sketches. So with Carl, I chat about how to have healthy conversations about money. Make sure you're subscribed to the Retirement Café podcast so you won't miss this episode. You can do so on your preferred podcast player or on our website at theretirementcafe.co.uk, where you can also find the show notes for this episode and some useful links. If you've enjoyed this episode, please do write a review on iTunes, as this helps people like you discover us. You can find the link to iTunes on the homepage of our website, theretirementcafe.co.uk. So, until next time, this is Justin King, helping you feel more informed in your retirement.
Thank you for listening to the Retirement Café Podcast with Justin King. To find out more, you can find us online at theretirementcafe.co.uk.